We are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. Today, it's all about what tax laws may change and how to react with Brian Reyes, JWB's trusted CPA. I'm your host, Pablo Gonzalez. With me, as always, the man I affectionately call GC because he's got genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And the star of the show today, as he wets his beak, it is the maven of financial information, JWB's trusted CPA, who has been studying dutifully for a great update on what is the rapidly fascinating, changing topic of tax laws and what is happening in this country in regards to real estate investing and future planning. His name is Brian Reyes. Welcome to the show, Brian.
Thanks for having me, guys.
Great to have you, man. I know that this is a heavily anticipated call. And the way that we like to tell everybody that's joining us is that if you came to find out about how to own rental properties in your portfolio, you're in the right place. If you came to get an edge on the Jacksonville real estate market, you're in the right place. And not in the order that I normally say it, but if you also came to find out about best property management practices for rental income property investors, you're in the right place. Next place to go for a consultation is chatwithjwb.com for a personalized consult and a value-added call. But right now, it is time to welcome our community who is already strong in the house. You ready for our roll call, Brian?
Let's do it.
All right. Roll call time. Andrew Barnhill, good afternoon, all. Carl Thompson, good morning, everybody. Everett Shapiro, he says, yo, all. And that is Jake's usual trademark, but we'll give it to you, pop. John Henning, good afternoon, all. Dean Curry, good afternoon from Columbus, Ohio. Chris Gonzaga, great day to everyone. Chris coming in from the Hudson Valley, New York. I remember Eileen Mateos, good morning, all. Must be coming in from the West Coast. We got Jay Miller with greetings from Tallahassee. Welcome, Jay. Sean Hanna, good afternoon, everybody. Ken Moline, star of the Not Your Average Investor Show. Good morning from California. Jen Filson, the fairy godmother of the Not Your Average Investor Show community. Good morning from beautiful Monterey, California. We got Anthony Didas back in the house. Hello, everyone. Hello, Anthony. Good to have you. Leslie Wilson tuning in from Denver. Hello, Leslie. Good to have you. Who else we got? Denny Davis. Howdy. Oh, Denny Davies is tuning in from Germany. Well, Auf Wiedersehen. Is that hello or is that goodbye? Anyways, hello in German to you, Denny. We got Carlos Andres Lopez coming in, just arrived to Jacksonville from Lima, Peru. Carl, welcome. Good to have you here in town. Lee Bishop is in the house, MVP of the Not Your Average Investor Show community. Aurora Carp says hello, everybody. Raj Bantu, hello, all. Good to have you. Victor Alinas is tuning in. Victor, welcome back. Hi, everyone. He says, Fatima Lopez. That's a new name I don't recognize. Welcome, Fatima. Hi, everyone, she says. And just so everybody knows, we do the roll call because this is an interactive call. We want you contributing to the show. I think that's it. It's just that was a longer roll call than usual, so I'm a little bit out of breath. But Brian, now we start the show with you, buddy, and I want to ask you one question. When we first started talking about this, you had to kind of cool the jets, right? Like you get in a lot of conversations of people wanting to pull the trigger based on news stories. Tell me a little bit about, what is the right way to approach when you hear something that's happening, a law that may be coming down in the news, and what you got to do with your financing that you talk with so many of your clients about?
Well, with whatever, tax reform, whatever it might be, you got to first kind of understand factually what's going on. Because if you start making decisions based off of commentary, you can really impact yourself. And we saw this back with some of the COVID stuff with PPP. There was all this information, and that was really the start in the flow of just mass information, people trying to get way out in front of this, right? Which is good, right? You definitely want to stay out in front of stuff, but you really have to be careful of going out too far, because you start making decisions based on what you think is going to occur. It can cost you a lot of money, right? So, we started hearing about the, tax reform, back when the presidential election was going on, but it really started getting big probably in, we'll say March. That's when the administration really started putting its foot forward, and putting information out as to what they wanted to try to accomplish, right? And back then it was pretty scary. You know, I mean, we were taking calls and people were like, I'm going to liquidate my portfolio. I'm going to do this. I'm going to do that. I'm going to sell my rental properties, blah, blah, blah. And my question would be like, relax. Because a lot of times, like, okay, you're going to sell your rental property so you can pay low taxes now. But what are you going to do with the money? Well, I don't know. Okay, well, let the economics. I always tell my clients, taxes are what they are. They're one of the largest expenses you're going to have in your whole life. So they are very important, right? But they are what they are. Let the economics drive stuff. Because if you're letting the economics drive stuff, then you're working with your accountants and lawyers on trying to structure stuff to minimize tax. You're doing it the right way. So back in March, you know, we heard 50% capital gains rates, you know, estate tax, all these really, really restrictive issues with what you can invest in your IRA. Real estate, maybe you couldn't invest in your IRA. I mean, it was like, holy moly, you know. So we were back then, I said, okay, I don't think half of this is going to pass. And I'm not going to get political, but just the political dynamic was going to be a challenge, right? And it was just throwing stuff out. I said, okay, well, let's see what occurs, you know. So it kind of went cold a little bit, you know, throughout the summer. There was still, you know, discussions. We were still taking calls. And then we really started picking up heat on this kind of late summer as to, you know, there was actually documentation coming out from, you know, the House and Ways committees and stuff of what a package might look like. And it's the evolution of this thing is it started here, and each time it keeps trickling down to what is more reasonable. I'll say this, since, you know, I've been practicing for almost 20 years now. You used to could really plan long out because you had tax reform kind of like this. I do think we're in an environment where this is it, right? But I mean, back in March, it was like to the moon. Like, this is just not even, it was just almost unconstitutional and unenforceable. So, you know, that's been the evolution. And even I was just looking as early as today, just seeing if there was any more news, because this is a big week. You know, they're talking about trying to get this bill passed, which I don't think it will, but it could. That's been the evolution of where we're at with this thing, you know, and we got a long way to go between now and the end of the year, I can assure you. So.
Brian, just could you give us a little bit of perspective as well? You know, we've had administrative changes in the past, right? When Trump was in office, it was a Republican-controlled Congress. Now it's the other side. And we had sweeping tax reform when Trump was in office. Can you give everybody a little bit of perspective as to when something does become a law, when, like, how much of a grace period before the changes get enacted? Is it something that, like, if the law goes into effect this year, like, that is go time? Or is it that you still generally have, call it a year before things tend to actually become enforceable?
Well, very good question. That's one we get a lot. And there is no perfect linear answer. You know, there is no law within lawmaking, right? Laws can change. You know, over the history since I've been practicing, there have been a couple of times during the year. Actually, Trump had it in his package where there were, whether it be deductions, income tax rates, where they bifurcated them in periods. It really, really makes it a challenge for the IRS because it's hard enough for them to just track payments and basic forms of income. But now you're bifurcating rates and laws within a year. Think of how a tax return gets prepared. You know, the software companies have to prepare all this stuff. And we still have this date of April the 15th. So this is all the stuff that all the people have to think about, you know. So we have seen bifurcated deductions years ago for bonus depreciation. You know, maybe you had like 50% for a period of year, and then if you bought equipment after September something, it was 100% write-off. So you literally would go through the equipment registers and 100% write-off versus 50. So my guess is we're still looking at 1/1/22 for all this, but we just don't know. We just don't know. But with every day as we get closer to the holidays and Thanksgiving, it's favorable for everyone to then go into the next year knowing that there's going to be tax reform. That is a given. I tell every client every day, we're going to have tax reform, and it's probably going to be next year. And you do need to start at least thinking about it, because you can do stuff this year to maybe help. But I don't know if I just getting it this year is just gonna be challenging with the way things are.
So Brian, it sounds like you're talking about when when it looks like it'll pass. Generally, once they pass it, let's say it gets passed, let's call it February. As somebody that is trying to plan out my tax strategy, if I make an appointment with you in March, does that mean that I now will be beholden to whatever got passed in February? Or is there generally like a grace period of time that one can make adjustments based on what just got passed?
Usually in that format, which is the typical, there's tax reform in February, March, and they usually backdate it to that January date. Now, one thing that was in the original bill with IRAs and a lot of that, which was really, really pretty scary, frankly. They were going to give, I've read it a couple different things, like a 3-year grace period to become in compliance, sometimes a 5-year grace period, because there's so many investments in these IRAs. And if you pass law and say, oh yeah, go unwind your investment in the next 3 months, it's just physically impossible, right? So there's usually grace periods per se, but if there's a bill passed in early spring, they usually kind of backdate it to the beginning of the year.
Okay. All right. That makes sense. Let's talk about it, Brian. I think the way that you described it, there's kind of like 2 bills in play right now.
Yeah.
Can you describe, what these bills were when they came out, kind of like what they started looking like when they first got presented, so then we can just dig into what they're going to mean?
Yeah. So there's 2 bills, and they're largely infrastructure and trying to create jobs. With that, sometimes you got to increase revenue, right? So the first, which was actually signed yesterday, is behind us. And so that was the kind of bipartisan bill, which is kind of your standard regulatory making of law, right? You get people together and they kind of agree on something. There's back and forth, and both parties tend to agree. They vote on it. And this was really a reallocation of CARES Act money. So there was a bunch of this COVID CARES Act money that was sitting out there in a suspended account. And they said, well, it's already been allocated for CARES Act. Let's just reallocate it. There's a lot of cool stuff in there, but there's not one item in there related to increases of tax revenue, because it was already money that had been accounted for. It's just reallocating, instead of giving them to hospitals and more businesses for PPP and stuff like that. It was just allocating them for infrastructure, roads, ports, such. So that was the one bill, which is now law, signed yesterday. The second one, which is, we'll call it non-bipartisan, and that's the one where it's something called reconciliation, which is not super new, but it's becoming more prevalent now with the political environment that we're in. And it's where they basically go through and just think of a budget. Think of your household budget. If you make $1,000, you can spend $1,000. So they're saying, okay, we're going to increase our budget by this, and then we're going to have offsets, right? And so this is the one that is really, really interesting in terms of they just have to have majority vote. I say the administration that's in power just has to have majority vote, which they control everything right now, but there's two maybe more dissenting type of senators that are just not quite on board. And that's been the holdup. And they have said from day one, if you look back at all this stuff, they've been very consistent from day one, even back in March, that, hey, we got to take some time with this, and it's not going to just be overnight, right? So those are the 2 bills. And the second bill is where all of the tax reform is. So.
Great. Okay. So it sounds like we're going to be talking about that second bill more than anything on this call. What provisions are in there right now, or what provisions do you see in there affecting real estate investors, the people on this call? Is there anything in those bills that you're particularly digging into when you're thinking of strategies for JWB and their clients?
Well, the good thing is it's been stripped down significantly back from March, thinking through the timeline of this thing. We went through back then 40 to 50% long-term capital gains rate, estate taxes. You can't invest anything in your IRA. And then they kind of stripped it down. We had some stuff that came out in July, and then again in August, then September, and the last piece of, it's not even legislation, it's really kind of commentary of this is what the bill might look like, was on 11/3, so a couple weeks ago, and it's kind of gone quiet. But in there, in the current bill, there's, as it relates, one thing, and it hasn't gotten a lot of play, is maybe what's not in the bill. Depreciation. For rental real estate folks, depreciation is very, very, very powerful, because if you have gross income of X, that depreciation reduces your gross income, right? And it increases your net cash flow after taxes. I'm frankly, just my opinion, I'm kind of shocked that there's been no talk of depreciation changes, because we are in a world with depreciation that's like it's never been. Pretty good for real estate. You can kind of componentize out things, but non-real estate, I mean, it's crazy the amount of depreciation you can take on certain things. So right now there's scheduled to be no depreciation changes, right? And they've said nothing about it. So that's one thing that I think people haven't really talked about for the folks that are tuning in here. That's really, really, really important.
And for everybody who is tuning in here and you're a fan of the show, you watch on Thursdays, to bring that full circle, when we go through our property evaluations and we talk about the 5 profit centers and we see the tax savings component on our evaluation, that's what Brian's talking about right there. So Brian, don't mention it too much. We don't want to rock the boat there. We don't want them learning that they could take depreciation away. But I'm with you. That's a big thing. That is a big win for real estate investors for sure.
Yeah. One negative for higher income type earners, there's this concept of tax increases on, say, 4 to 5 people making $400,000 or $500,000, just tax rate increases. If you've got a bunch of rental properties and they're just generating a ton of income, even after your depreciation, mortgage interest, all those items, you could be looking at higher tax rates going into next year than this year. And so what we're telling our clients is, if depreciation is the same and you think you're going to be in a higher bracket next year, then those expenses would be worth more to you next year to defer, right? Because if you have an extra expense this year, it's maybe at a 30% marginal deduction for you, the highest current rate. If those highest rates go from 37 to 40, it's worth 40 cents to you next year. So that's a 3% permanent tax savings. So tax deferral is strong, but permanent tax savings is way better, right? So that's one that some people forget about. So we're sitting at, talking to a lot of our clients right now. And then capital gains rates. Go ahead.
Can I ask about that? Because I probably prepared for this session a little bit more than most here. I wrote some notes down. And what I had heard from previous versions of the bill, and please correct me if I'm late here with some of the more recent ones, is that are they changing the brackets as well and moving the brackets down to where, I think the notes that I had was that it was, if you made $650,000 or more, you were in the top tax bracket for couples. And I think not only are they thinking about raising that to 39.6, but also dropping the top tier to start at, I believe it's 450 or so for married couples. So it's kind of both effects are potentially on the table here. Am I understanding that right?
You are. You definitely are. And I don't know every single bracket perfectly, but what happened is with Trump a few years ago, he actually increased those brackets. So you were in kind of lower to middle income brackets for much longer periods of time. So I think they're going to decompress some of those brackets. But what I have seen is there's, other than the SALT deduction, which we can kind of talk about that, there's really not a lot that's in there that is under this 400,000. So, thinking through where you're at, and if you are up above that, thinking through, if let's say you own some apartment buildings, right? And or some duplexes, and you're thinking about going and putting new carpet in or doing painting, rehab, and you're like, well, I could probably do it next summer. And you're going to be in the highest tax bracket this year, next year, do it next year because it's going to be worth more to you to do it next year. Again, let the economics drive it. If you could get materials cheaper this year, then that makes, sense. But that's one that people just forget about, is trying to plan when to put those expenses in. And you're right, Greg. I mean, those brackets might spread out, but again, we haven't seen a lot in there that under the 400,000 to 500,000. There's not a ton of kind of tax increases. Capital gains rates, right? So it's my belief that we're probably going to settle somewhere on 25 to 28%. We're at 20% right now, not including surtaxes. So I always make the economics. If you said, hey, I was going to sell a couple of my rental properties, or I was going to sell some stock and maybe position that money towards rental properties. If you were going to go ahead and do it, trying to get that done before the end of this year at 20% versus doing it next year at 20 or 20 or at 25 or 28% makes a ton of sense. 1031 exchanges. There's been some back and forth, and it's kind of gone silent on that. They were talking about doing away with them back in March altogether, and then they kind of phased it down. I've seen some discussion of maybe if you make over $400,000 or $500,000, you won't be able to do 1031 exchanges next year. The first bit of legislation a couple of years ago actually changed the 1031 exchange rules. Used to, you could do 1031 exchanges with cars and all types of things. Now it is specifically real estate. So you can't do stock or anything like that. So that's one to think about if you were thinking of positioning from one market to the next, say from Atlanta to Jacksonville or something like that. If you're really high on Florida versus Jordan, maybe a good time to try to do that now to get those 1031 exchanges in before they do away with the rules. Does that make sense?
Yeah. Could you, maybe I wasn't aware of it. So am I understanding it correctly that 1031 exchange being removed from real estate is on the table still?
Oh yeah, no doubt about it.
Gotcha.
Yeah.
That's no bueno. We don't want that.
Yeah. So that's something to look at. It was big time early on. It's gone a little bit aside. You hadn't heard as much about the 1031 exchange lately. So what's the chances of that? I don't know. But again, if the economics said, hey, I liked Atlanta and I'm going to position my assets in Jacksonville now, and I want to do it in the form of 1031 exchanges. And you said, well, I'm going to finish them all up by Q1. Let's see if we can get them done by the end of the year, just to make sure you lock those in, because you would hate to kind of let it linger into Q1, Q2, and then boom, they bust you.
Yeah. Well, and for all of those out there that are trying to do that, it's a really hard time to execute that on a short basis, right? It's November 16th now, and you got to do it by the end of the year if you want it to be super safe. It's tough to find inventory. For all of you who are looking for inventory, of course, it's a great time to call JWB because we actually do have inventory for all of those folks that are looking to do 1031 exchanges. So didn't realize that was so time sensitive, but definitely an opportunity for you guys to talk to us about that.
Greg, let me ask you a little bit more about that, right? Because we have positioned this idea. We keep talking about the fact that Jacksonville is the high growth market. So if you are thinking long term with a rental property, and you are gonna invest long term, it would make sense to pull the trigger in moving 1031 exchanging from something in Massachusetts and moving it to moving it to Jacksonville property. Do you think that there is, if somebody hadn't thought about this already, do you think that there is an opportunity to get something like that in, like what, based on the laws of like naming the property and stuff like that?
Yeah. And so I think your question is, can a 1031 actually be done and closed by December 31st? Yeah, absolutely. I mean, if there is going to be financing in place, it's going to be tougher, right? We're about 45 days out, and we've got, 2 weeks that have some semblance of holidays in between them. And so things generally slow down for that. So if it's financing, we need to be on the phone like today talking about it. Many times 1031s can move forward with cash. purchases, and JWB has those properties available now. So cash is certainly not a concern, and financing, get on the phone with us now, because we need every day to make sure we could close by the end of the year. Now, and then what we're saying here is that there is a potential that the 1031 may be taken away, but let's go back to Brian's original message here, which is that this is not in place at the moment. So this would be if you are already convinced that a 1031 is the right thing for you to do at some point in the future, and you were thinking about doing it sometime in the near future, it would be to your benefit to knock it out immediately. Not necessarily for you to change your entire game plan just because of potentially what may happen. Is that fair, Brian?
Absolutely. I couldn't have said it any better. And one thing too, because we've kind of talked about the timing of this, there could be a case, maybe a case that if you sold a property in your assets were with a QI, qualified intermediary, going into Q1, there's a pretty good chance it would still qualify for the tax deferral when you sold the property. So getting the full thing, and again, we're speculating a little bit, and as I've talked, I hate to speculate, but I could see a case just based on normal tax theory where if you had the transaction that was closed and you were just waiting to get the closing done, or you closed on the sales side, so you got the tax deferral this year, and you were just waiting to get the properties closed, the money's sitting with the QI. I am not a 1031 exchange expert. We kind of rely on others, but just based on my knowledge of tax theory and how some of this works. So that's just something to keep in mind. So you could lean in a little bit, and maybe the second closings on the acquisitions occur in, Q1 of 2022. So, yeah.
Brian, I got a question for you on cap gains. And I think it's cool to see how much has changed as this bill has come down the pike here. But what I was listening to and reading about originally is that there was some talk that they were going to try to equalize capital gains rates and ordinary income.
Oh, yeah.
Which is mind blowing to me, because there's huge just profits, huge incentives, huge benefits for long-term investments. But from what I understand now, that's taken off the table, whereas they are not going to equalize them. They both are going to increase, but at least they are not going to equalize them. Am I understanding that right? Okay.
That's what I've been saying from, back when I was like, I just can't fathom a place where we're going to have capital. It's just all income, right? Because then there's so much risk that goes involved with capital assets, right? And you need to reward folks for that risk. We're at the lowest it's ever been at 15 to 20% plus any surtaxes. I again could see that. My gut's telling me 28, but I could see it settling at 25. So I mean, if it's a big transaction, I mean, that's a lot of money, 5 to 8%. That it's a big number.
So for us as rental property investors, right, this is a big win. The fact that there is going to be an incentive for us with reduced taxes for holding on to your assets long term is a big win. We talk a lot about my portfolio, our company portfolio, our clients' portfolios, right? And the value of buying and holding for a full market cycle. Well, I was absolutely paying attention to that, because that would have reduced the incentive for everybody to hold on long term. So I'm super ecstatic that is no longer on the table.
Well, and I feel like a huge part of my practice sometimes is trying to put income in the right rate buckets, with, hey, let's talk about some ways to structure this to get capital gains. And so that would, take the sword out of my quiver, so yeah, I think it's going to sell at 25 or 28. Two other items. One that's not really related to tax increases or decreases, but I think it's something that I'm becoming more passionate about and talking to clients is, it sounds nerdy and I am a nerd, but IRS enforcement, there are going to be lots and lots and lots more audits. And we've already seen it right now, that even the position that the IRS they're starting to take, I've got a couple of IRS exams open right now, is if you can't support it, appeal, we'll see in court. And that's a challenging place to be, because you now, and that maybe I just have a couple of challenging auditors, but everything you hear and the numbers, this 40 to 80 billion dollars worth of money going into the IRS, that has not changed. That is still steady Eddie from back in March. So there are going to be more IRS audits. So just making sure your house is in order, making sure your records are lined up. I work with a lot of real estate people. You get stuff going all over the place. Slowing down, making sure bank accounts are set up appropriately. You're paying things out of the right accounts, because IRS agents, they have a job to do, and their job is to check boxes, right? To go through, and if you have on your rental schedule, your Schedule E gross income, boom, 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 then if it doesn't check out, they can say disallow, see in court. It really, and Greg, I can see you guys picking up like on the property management side, because I've already had some discussions with some of my clients who have 3, 5, 10. They're do it yourself, which is great, but if you get a nice printout from JWB, right? And the IRS says, okay, prove out your gross income. Boom, there it is. And they love IRS agents like something real clean. So it's not related to increase in taxes, whatever, but you start having to pay an accountant to sit on an IRS audit with you for 18 months. That can get quite costly. So
yeah, one of the best expenses, investments, I call it, is paying Brian and Pivot CPAs, right? It is not just avoidance of potential audits or other things like that. It goes beyond that, right? When you have a trusted advisor like we have with Brian and his team, it is a revenue generating opportunity as well when you talk about some of the tax savings that we can do. So I would highly recommend, especially as you get more than one property in your portfolio, really start to do your due diligence, find a trusted partner, and include that in your expected expenses every single year. It'll be worth it.
One other big one that has not got much play. Sorry, Paul, I think this is an important one. It's not got much play, but I think it's one of the biggest one is right now there's something called the net investment income surtax, which is a 3% surtax on passive income up over a certain threshold of income and capital gains. They're talking about that being subject on active income. So if you're a real estate professional right now, you don't pay that. So if you make whatever, millions of bucks, you're not paying the net, which is really just doubling Medicare is all it is. So that could be a big one. If you're upper, close to me or up real high, that could really, really, really hurt you. And that's something we're monitoring, and it's got teeth right now because it's not just for real estate, it's for operating businesses too. And they're trying to raise payroll taxes is what they're trying to do, Medicare taxes.
So is that the same? Because I wrote down some notes here and I didn't fully understand where that one played in with this one that I wrote down. What I wrote down is that there was movement to kind of remove the incentive of creating an S corp, right? That's it, right? So when you create an S corp, you allow yourself the opportunity, and again, fill in if I'm screwing this up, but you allow yourself the opportunity to make distributions and to not have to pay the, I think it's the Medicare, it's what, 3.8% or so, the Medicare tax?
Mm-hmm.
Yeah, plus the Obamacare thing. Thing is a technical term. Make sure you write that. So I mean, that's what JWB is taxed as an S corp, right? We don't pay that additional 3.8% on the distributions we make. And that is a huge deal. I wrote that one down. I'm like, oh man.
Huge. And it's not getting a lot of publicity, kind of like you're not hearing anything about depreciation, but it is just, and it's because even ignoring real estate, but a doctor, right? A doctor that makes $600,000 that has a W-2 of $150,000. So that difference, that delta between 600 and 150, they're not paying this surtax on. They're talking about closing that loophole up over $400,000. So that's going to bring a lot of people into this that it's still in this bill, and I'm hoping that they change it, but it is still lingering around and I can't get it to go away. I keep thinking when I pull it up, it's going to be gone, but
that's the one that freaks me out the most.
well, it is. People get so caught up on, some of the stuff that's getting all the publicity, but some of these little ones are always nerds like me. I'm into some of these other things, I think that's it. Is it, the big items, I think depreciation, looking at 1031s, the timing of expenses and income is huge because you have an opportunity here with this increased tax rate to get some permanent tax savings, which is very powerful. And just being aware of as the bill, reading and being diligent with your reading through now and year end and even going into Q1. Let's see. The IRA stuff is kind of off the table, which is good. So.
Yeah, let's dig into that because that one was also on the range of what was freaking Greg out the most. Like the IRAs was right there for a while there. And I would love to hear the update. Maybe you could tell people what was on the table so we can still freak people out a little bit because that's always fun, and then tell them how it's removed. That would be pretty cool.
Man, I can tell you when I was reading the IRA rules back in March, it was our busy season. I was like, I don't think I could sleep at night if I kept reading this, So I was trying to read, but I was trying not to, and I started reading it. I mean, there are all types of rules to where certain types of people couldn't own real estate. You had unwind things. If you had ownership in a business, you couldn't lend. There were a lot of things in there as it relates to alternative investments. Now, I'll say this: I do think there needs to be maybe a level of enforcement around IRAs because what they're trying to do is it can be the wild west out there sometimes with people just doing whatever in these things. So there probably needs to be some enforcement, but going from none to you can't own real estate, you can't do this, it really was going to pigeonhole people. And how do you unwind that? I don't know, but they completely stripped it all out as of this last deal. Now, there'll probably be some stuff related to penalizing people that have like $10 million in Roth IRAs and stuff like that. Backdoor Roths. I don't know, maybe some of our users have heard of the backdoor Roth, where you do a non-deductible IRA contribution and then immediately convert it to a Roth. It's a mechanism that allows wealthier type people to get money into a Roth. They're talking about doing away with that. And then doing away with Roth IRA conversions. With some of our real estate clients that are more like this than this, let's say you made a bunch of money last year and this year you reinvested that money in some apartment buildings and you did a cost segregation study and you plowed through millions of dollars worth of depreciation. So you had $1 million loss sitting as a net operating loss on your personal income tax return when it flowed all the way through. And you happen to have a $600,000 traditional IRA, it was your 401k you left. You could convert that from a traditional IRA to a Roth and it would offset that depreciation. So we do that. I probably see 5 to 7 to 10 of those a year where just for whatever, there's a lot of different circumstances. I was just working with a guy this morning on one. And those can be pretty powerful, because if you're young and you can get that amount of money into a Roth IRA, that is significant because you don't pay tax on it. Plus there's no required minimum distributions later in life.
So that is still on the table. The removal of the backdoor Roth conversion is still on the table, and the removal from the notes that I had, I believe they said that you can't do Roth conversions at all. And I think they were starting it in 2032. So there was some time. Am I understanding that right?
I read that too. And I wonder if that 2032 is a misprint because
I know I was like, man, 10 years from now. All right. That's going to be 1 or 2 more presidents. All right.
It seemed like to me, it meant instead of 2031, it meant to be 2021 would be the last year. Cause I was just talking to this client, very, very sophisticated client. We're going to end up doing a significant amount because he and I both kind of read it. We're like, man, that just doesn't seem right. Maybe it is, but I could definitely see
I think
there's
they could
definitely
make
going to be.
a few other typos here, like the tax brackets were actually going to be like, 10% lower. Maybe a few other typos would really just make this, moot discussion, but no.
Guys, while we're on the topic of IRAs and sophisticated investors, Lee's original two questions here in the Q&A have to do with this, right? So he writes in, hello, Brian, do you have any opinions on the following issues? Section 138.314, limiting the self-dealing transactions to IRA owners. You cannot invest into a business in which they have 50% interest or greater as an owner. Does this mean that you cannot use IRA money to create a solo 401k LLC? This clause also states, prevent investigating an entity not traded on an established market, loosely interpreted as not able to invest using IRA money in syndications, buying, say, a shopping center. That's his first question.
So the good thing, both of those things were stripped out. So, because it was supposed to be 10%. The current rule, as I understand it, with self-dealing, is 50%. They were pushing that down to 10%. So that was going to be a big one. Could an IRA set up a solo 401k? You got to have earned income, so that might be a challenge there. But the good thing is that the Roth IRA provisions and the IRA provisions that were in there have largely been stripped out. But you always, with increased IRS enforcement, which I did discuss, I would highly suggest reviewing all of your assets, your alternative type investment assets that are in your Roth or your traditional, looking through what you participate. If you have partnership interests, do you manage these things? What do you do? Because I do think there'll be part of this big funding for the IRS. I think some of it's going to be enforcement going directly against IRAs. I've seen one IRA audit since I've been practicing. I think we're going to see more and more of those for sure. So
big picture is there will be more enforcement. However, there is nothing in the proposed legislation that says that you can't own rental properties in your IRAs. You can't invest in private placement funds in your IRAs. That is not on the table as of the most recent bill, which is a huge win for all of us who are watching the show right now.
And traditional lending too, if you were to lend, because that's just straight interest income, just as if you would have bought a CD or something like that, certificate of deposit. So
there you go. All right. His next question was about that backdoor Roth conversion. Sounds like that is still on the table, right?
Well, yeah, they're talking about doing away with that piece. I'm surprised they haven't done it earlier. We also, with that one, we do see a decent amount of kind of target audits to where the documentation's kind of mucky. So again, this is more IRS enforcement where they'll just start looking around and stuff. Oh, well, this documentation, once you get them in, they start, oh, well, let's take a look at this. Let's take a look at that. So if you are doing backdoor Roths, make sure your documentation is really buttoned up. So
there you go. All right. We got one more. I'm going to fast forward this question because it's in the IRA question, but Drew Barnhill asks, if they do away with Roth conversions, will you still be able to roll a Roth 401k into a Roth IRA?
Yes.
Right.
Yeah, because you have after-tax money going to after-tax money. What they're trying to do is, because what they did 2 year or two ago is there's a lot, as you can imagine, there's a lot of wealth in the United States in tax deferred accounts, right? So they're trying to capture that. There's a lot of wealth that gets transferred from one generation to the next. And there used to, let's say you had a wealthy individual that died at 60 and he or she had kids and the kids were like 25. Those kids would have to pick up that income at very small amounts every year. So it's staying tax deferred. Now you got a 10-year window, right? So there's 10-year window versus these stretch IRAs. So this is not really real estate, but if you have people that have passed away, be familiar with it and try to put that income in the right years. But they're really trying to capture these tax deferred money, so they don't want more going out the door. It was tax deferred. Now it's, buried into a Roth. So.
Okay, got it. We got 6 more questions that are open right now. So Everett Shapiro asked, this is something we were talking about, right? This like value of having a trusted CPA on your team. He asks, how does one find a competent tax strategist to assist a retiree in planning investments and withdrawal strategies? Brian, do you have any kind of like feedback on how to evaluate somebody when you are a retiree?
Yeah, I mean, talk to people that you know first, because largely our firm's referrals, we get referrals from our clients. Talk to people your friends, financial advisors, your lawyers, and make sure that you can get in touch with the person. I mean, if you call the person for an intro or email the person for an intro and you don't hear from them for 2 weeks, that's probably the quickest you're ever going to get in touch with that person. I can't tell you how many times we get clients just like, I called Sally, my CPA, and I haven't heard from her in 3 months. So make sure that you understand the level of communication this person is going to, because we are in these dynamic changing society with tax laws. You don't have to go, but you just want to be able to call somebody and just say, hey, here's what I'm reading, here's what I'm hearing. Help me dispel this, or help me kind of make sense of what it is. And understand the firm too. I can say this. I mean, we have 9 partners and we're about 50 employees. Make sure there's bandwidth within the firm, because these tax laws are ever changing. We have people within our firm. We don't really specialize on anything, but we see different things, and it's a nice thing to be able to pick up the phone and have some communication with one of my partners and say, hey, what do you think? So I think that's big. There's a fine line of being too big, right? So make sure there's some bandwidth and that you can get the answers that you need. And then just your gut's a big piece of it, man. Just having some conversations with this person and see how you feel talking to them, because you're going to be talking to this person 3 or 4 or 5 times a year about things, and making sure that they like to work on those types, the types of things, the issues that you have.
Yeah. And I'll jump on there too. The gut thing for me, I really agree with, right? You know who you work well with. And one of the things that helped us really, establish great partnerships with Brian and with our other partnerships that we have in all facets of our business is, does that person or does that team truly put in the time and effort to understand our business? And, I know it when somebody understands our business, and I know it when they had the opportunity to try to understand our business. And then that, 2, 3 phone calls later, I'm still repeating things that they probably should have known or whatnot. So let that be another part of your guide there. Make sure that they take the time to understand your business and don't accept working with partners that don't truly understand it.
That's really, really good advice, right? This idea that it's kind of like when you're getting a job, like if your job interview process is clunky and it doesn't go right, that's probably the best that they're going to treat you, right? So how much on the front end they're responsive to you and how much care they take into understanding your business is a really great analysis for future of your relationships with just about anybody, especially a CPA. All right, let's keep rolling. We got 5 more open questions, and I want to get you out of here, Brian, in time. So Eileen Mateos has a question. Hi, Brian. I am 53 and a new investor from California and just recently joined JWB and purchased 2 new construction properties, not ready to close till next year. That's awesome, Eileen. Welcome on board.
Woo-hoo.
I am a California
Congrats.
resident and buying rental properties in Florida. What should I be prepared for in tax liability wise? And what strategy should my soon to be real estate CPA be implementing that would minimize my tax liabilities to both states? Can JWB assist new out-of-state investors like myself to find real estate CPAs to do my taxes?
So the good thing is investing in Florida, there's not a lot of taxes, right? The baseline, you got to pay real estate taxes. So when you close, the county will have all that information and you'll pay that tax bill. Usually in November, you'll get the tax bill and pay it. So that's just kind of the baseline. There's no sales tax on residential real estate like this. So you're fine there. So you don't have any sales tax. We have no state income tax. So you don't have to worry about paying state income tax. To the extent you have an LLC that owns the properties, you might be required to qualify to do business in the state of Florida. If you are, there might be some small fees, $150 or something like that, to qualify to do business in the state of Florida, but maybe not. But that's it. And then, you know, as it relates to California, California is going to tax you on your overall income. And if you had state tax credits, like if Florida had state income tax, you would get a tax credit to offset your California income tax. For you, it just sounds like you have a California tax issue that you have to plan for, maximize your depreciation. If these are new construction projects, JWB has always done a good job of kind of sending you a breakout of what was done, because you can componentize out some of that stuff, you know, instead of land and then you're building at 27 and a half years, you can componentize out some of that stuff and get better depreciation up front. That may be good, maybe bad. You have to just think through it. But yeah, in Florida, there's no state income tax. So, you know, welcome to the state of Florida.
And Greg, kind of, can you touch on the point of like, what does JWB help you do to assist?
Absolutely. I mean, this is what your portfolio manager is here to do for you. Your quarterback here. So if you are in need of a referral for accounting and CPA services, you know who we're going to refer you to. And beyond that, Eileen, again, congratulations for your first 2 properties. We're so excited for you. You're going to need a full team here. You've got one here at JWB, but there's other financial professionals and other legal professionals. And if you need those types of referrals, talk to your portfolio manager and we'll be happy to refer you to anybody that we trust.
Cool. Sounds positive. And the answer is yes, JWB does help. All right. Dean Curry has a question. Do these numbers, 450K, 600K, ever get adjusted due to inflation, or in 10 years, will the numbers still be at these fixed amounts from 2021 and 2022?
Ooh. Trying to plan for tax law 10 years out. Man, that's tough. I mean, historically, rates, credits, everything gets adjusted for inflation. Where we are now, I just don't know. I tell people, you know, and I mentioned this, we used to kind of have this, you know, now we're in this with tax reform. Just if you're planning out things, try to put your deductions in these years and, you know, put your income down in these rate years. It's hard to do, but trying to plan out 10 years from now, it's just, you could do it, but there's so many variables that would go into that. It would be a challenge. You could do some high level theory type planning of, if you think you're going to be in high tax brackets, what should you do now? You know, should you do charity stuff, yada, yada, yada. But to try to put what you think the brackets are going to be in 10 years, that would be just throwing darts at this point. So.
Makes sense. Brian, I want to shoot a couple more darts your way. We got 3 more questions. You want to try to knock them out rapid fire and get you out of here by 1:30? See if we can do it. All right. Yep. Drew Barnhill asks, if you do not take your available depreciation write-off each year, does it still reduce your cost basis for capital gains when you do sell?
Technically, yes. It's the available depreciation. That's right. So the IRS would look at, even though you didn't take the depreciation, it was available. Practically speaking, we see it where we pick it up from someone else. We just have the communication with the client. And then if the IRS comes in, most times they're okay with that.
There you go. Ken Moline asks, do you foresee an attempt to tax cash generated by a refinance process?
No.
All right. Drew Barnhill, last question. Isn't means testing for capital gains taxes on the table as well?
Yeah, there's all kinds of things. I don't know. I mean, I still go back to, I don't think much is going to change with, I just think we're going to see rates. You know, I think we're going to settle like 25 to 28% rates on these long-term capital gains. You know, the definition of capital gains might change a little bit with crypto and stuff already, because those things are kind of hard to navigate what they are with some of the wash sale rules and stuff. So we're going to see some definitely some tax reform around that. But as it relates to real estate, you put it available for rent. So if you have a rental property and it's not rented, as long as it's available for rent, that's when your holding period starts, right? Then 12 months after that is if you sell the property, that's when it's subject to the long-term capital gains rates. But rental properties are great long-term investments. I would suggest not, thinking of a 1-year window for these things.
Brian, this is good stuff, man. We had great questions from the audience, a lot of participation. You did your homework and came prepared. Super, super valuable. Is there any kind of like parting thoughts you want to leave with folks of kind of what you're expecting or what the high points are here?
We in business today, it is so easy just to crank. I do it. Greg knows. I email him at 4:00 in the morning sometimes. He's like, go to sleep, man. Or like, why are you awake? Look,
Absolutely.
I am first and foremost a husband, a father, before I'm a partner of a CPA firm. Taxes are what they are. Business, love your family, love your friends. The rest will work itself out. So
that's beautiful. Joanna, let's get him a little piece of him cutting that out and give him a call sign of what he stands for. That's a great message.
I didn't know accountants had emotions. I mean, this is like a beep, 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 beep news break here. That was beautiful, man. And you are quite a family man. Your family's beautiful. So we love you guys. And we love that you spent some time with us here on the show. It's been incredible, man.
Well, thanks for having me.
Yeah, man, it was a real pleasure. Thank you to the Not Your Average Investor Show family that came out. We had 40 plus people in attendance, over an hour. We never take it for granted that you take a full hour out of the middle of your workday to hang out with us. It means the world that we'll be able to bring this amount of value. And Brian, we couldn't have done it if you didn't take an hour plus all the hours you spent researching and preparing your notes and showing up here ready to give like a keynote presentation and answering all these questions, man. Really, really great job. I want to hit it again. If you came to find out about owning rental properties, you were in the right place. Property management, didn't talk about it very much, except for, how depreciation and everything fits. And we didn't talk a lot about the Jacksonville real estate market. But if you want to continue the conversation, go to chatwithjwb.com, map out a call, have some value added conversations with the team. Check out our content stream. Joanna was in the chat sharing past episodes that relate to this stuff. Join us in the Facebook group. Hope to see you there. Thank you for letting me be a part of this. We'll see you on Thursday for the JWB Rental Legal Property of the Week. And GC, I'll give you last words, my man.
Yes, Brian, buddy, it's been awesome. Awesome to have you here, as Pablo mentioned. I want to say thank you so much. Thank you to the community. Brian, when we're able to get inside the headspace of a truly influential business partner to JWB, I think the whole community just really benefits. And so we're just so excited to have you on the show. Thank you for being so willing to share your time, and appreciate all of you again for being here. This is the type of show that we want to be. We want to be talking to those thought leaders here that can help you in your investing journey. So big win all the way around, and we'll catch you on the next one there. We'll see you guys.